Hi, I'm Steve Van Metre and welcome to your Monday Night Premiere, where we take about 15 minutes every Monday and Wednesday and try to make sense of a stock market and economy that right now just doesn't make a whole lot of sense, but it doesn't stop us from trying. So if you kind of notice I might be wearing the same dress shirt I was on Friday, well, you're very astute, because today was the 6-week follow-up from my wife. So we went down to Cedars-Sinai in Los Angeles to see how she's doing. And the good news is, after a quick x-ray, which really actually didn't show anything different than we saw, for those of you that actually have seen her x-ray following the surgery, of course everything looked great. Nothing was damaged, no cracks, no nothing, which is awesome. Her pain's been going down. It's kind of amazing. Doctors tell you we got to wait out that 6 weeks. And as you get there, no matter what you've had done, things just get a lot better. And we're celebrating 6 weeks clean, not 6 weeks, also 3 weeks clean off of opioids. Not that she was abusing them, but it was just she needed them for all the pain she was in. So now she's completely off opioids, which is pretty dang impressive, and only on Tylenol, which is something we actually never thought would happen. And so she's getting better. The opioid withdrawals are going down, thank goodness, because they're not fun. For those of you who you've been through it yourself or been through it with a friend or family member, it's no fun. So the good news is she's progressing, is now going to be able to start physical therapy, and that will keep her day pretty busy between that and the outpatient drug program that she started to help her just deal with all the issues that go with opioid withdrawals. And I think counseling is a wonderful thing, and I think she's going to get a lot out of it. So that's all good news, good report. So for now, we're not due to see the doctors for about 7 weeks, and we'll just assume that she's going to keep getting better. So back into the markets. Today was a very subdued day. Not much going on in the markets in terms of trading. There was no major economic data that came out today. Trading volumes were weak, and we're on a short week to begin with. And either today or starting tomorrow, the chart, there's a line in between the graphs. So today or tomorrow, we hit the full 80% corporate share buyback blackout period. And one thing that's kind of interesting is we do expect the market to sell down, mainly because we know that earnings are not going to meet expectations. Now, I'm going to tell you how they're going to, is because what's going to happen is analysts are going to revise their earnings projection right before a company announces to say they beat. Now, the problem is when you hear that a company beat earnings projections, you want to say that, hey, they were targeting a 5% growth and they got over 5. Well, a beat could also be, an analyst could say that their earnings could drop by 5, but maybe they drop by 10, so the analyst revises it right at the last minute, which they're allowed to do, and say that they're projecting, minus 9% earnings growth. And if it comes in, where the analyst would predict minus 11% earnings growth. So if it comes in at minus 10, it was a beat. And of course, that gets misinterpreted by investors who think a beat is, another win. And it's all relative. When earnings are contracting, so should stock prices. But as we've looked at on Friday, over the last 4 years, $1 trillion net of share buybacks has been driving this entire stock market. Everyone else has been a net seller: foreign investors, corporate investors, or retail investors, institutional investors. Everyone else has been selling, pretty much except corporations, who have been net buyers at tune of $1 trillion in stocks. And of course, we know, based on the growth rate of the money supply and the monetary lags, they cannot indefinitely buy the stocks. So investors who keep thinking that this market is going to rocket forward for the next several years, it doesn't look like that's going to actually happen, and we might address that at some point in the future. But in the meantime, the content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation of buyer selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity and opinion expressed in the video that I'm going to do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So what I wanted to do today, since there wasn't a whole lot of information the markets were giving us, I thought we'd go take a look at how hedge funds are positioned. Now, one of the best resources that I have for this is a website called Hedgeopia, And every Saturday, he updates this based on what's called the Commitment of Traders Report, or which is the weekly required reporting for large institutional and hedge fund managers who need to report their positions to the public. And so he puts it on here. It's called the COT, Commitment of Traders, Peek into the Future through futures, how hedge funds are positioned. And so let's see what we've got. We see that hedge funds, and I kind of thought this was going to happen, that they were going to see this as a bottom in the 10-year treasury market, and that they were going to increase their short positions. And so these green bars that are going down from this baseline, this says that the hedge fund managers are shorting or selling bonds again to drive interest rates up. Again, everybody thinks that the global economy is going to reflate. There's going to be a massive amount of inflation, but you can't get currency inflation when the growth rate of the currency supply is falling. It doesn't make any logical sense. It's just one of those things where modern day investment managers are so focused on price or what they believe that they can't bother picking up a history book and seeing what the truth is. Let's look at the 30-year treasury bonds. As expected, we would see a little increase in a short position. You can see the hedge fund managers backed completely off of this after they got their clock cleaned on interest rates falling. You see that same trend here. So you can see they were really heavily short, and as interest rates came down, they were forced out of their short positions. But there's still a lot of short bond positions out there, even outside of the hedge fund manager world. I mean, there's so many short bond positions. It's crazy. Now, one of the things that's been driving oil, again, is this reflation trade that, all of a sudden inflation is going to take off, the global economy is going to boom. Again, something that does not happen during monetary decelerations. And look what happened with the hedge fund managers. They kind of got beat up here as oil collapsed and they lost money. And what did they do? They drove it right back up. They got flushed out of their long positions and said, hey, this is too cheap. Oil's got to be, up again. And so you can see they're taking some big, long speculative positions here. And once again, my contacts inside the oil industry, which, I believe it or not, I got contacts out in the field all the way up to some very, very high-level contacts. And they're all saying there's a ton of oil out there. Not all of it's been being reported. A lot of it's on ships sitting in ports. And so they're saying, don't buy into the hype. Oil prices are most likely coming down first. At that point, what you want to see is the Fed capitulate, start aggressively lowering interest rates. That's when you'll come back and try to catch that next big rally as everyone buys into the reflation trade that will ultimately fail due to the monetary lags. But so there's a lot of mispositioning in this market. Either these people know something that my contacts don't, or they're speculating, and the reality is they are indeed speculating on the oil market. Let's see. They went back to a net short position in the S&P 500 after missing out on this entire rally. In fact, they were short this rally. That means they lost money going into this rally, and then they got a little bit long and then tiny bit short. We can see your Euro futures. Not many people understand Euro futures, so we'll skip that. Gold, we can see they got long, and prices coming down. We'll expect them to back off. We'll look at gold here in a minute. Time dependent. And NASDAQ tech stocks, they're net long slightly, not anywhere near where they have been in the past. And small caps net short. That makes sense. US dollar, they're bringing their long positions down, so the dollar's starting to roll over, as I suspected it probably would. That will be a catalyst for gold. It will help gold. But here is the one thing that makes absolutely no sense. It's this short volatility position. Markets are back shorting volatility, or it's like the spring that moves markets. So as volatility goes down, stock prices start going from moving like this to like this. When everyone is on the wrong side, or not necessarily the wrong side, but when you have too many people on one side of the fence in the market, some big deep-pocketed people will come and shove it the other direction and cause a market unwind. So when you see this chart and you see that volatility is low, as being suppressed back down to where it was, the lowest point in history. Now, volatility hasn't fallen to this low point in history, but from a speculative standpoint, the bets on volatility going down are pretty much right back where they were before volatility exploded. So you have a very lopsided market right now where speculators, hedge fund managers are very, very net short this market. That is not an indication that equity prices can go a whole lot higher. In fact, it's telling us they really aren't going to go a whole lot higher. And from my sources who have ties to, I'm going to pull up the gold chart while I'm chatting here. Some very large, I've got connections with people who know people who are billionaire money managers. Not that they are billionaires themselves, but they manage billions and billions of dollars. And here's what we're hearing from them. They are pretty much just sitting on their hands. They're not buying, they're not selling. They are not certain about this market. So what we're seeing is people that are in this market aren't certain. They're just holding. We're seeing corporate executives selling against them directing their companies to buy back in. And we're seeing people that are in cash or cash equivalents who think the market's too high, that are just saying, hey, this market's too high, I'm going to wait this out. So let's take a few minutes and just kind of look through, see if we can find some interesting charts. Gold, we're looking for a breakdown of roughly 1285 today. It got a low of 1285. Here it is, low, 1285.3. So it came right there, bounced off of that. And you can see the red candlestick mean is still closed lower. We're looking for a breakdown of 1285 to take us somewhere down into this between 1200 and 1250 range. I think that's where we validate. Here's where the real buyers are at. And then that's now I get a lot of more comfort level buying into the gold mining space, because I know who's bought back here, and I can just zoom out and I can say who bought here. If it comes down to hold support here, it tells us that there's some very big deep-pocketed players were buying here, and that is a nice safe zone. Anytime you're investing, you have to look at your upside and your downside, upside potential, downside risk. So people are like, well, why don't you like stocks right now? Well, what's my upside potential? 5%, 10%? What's my downside potential? 50, 60, 80%? It just doesn't make any sense. The risk to reward ratio here, if I concocted one, doesn't make any sense. Now, if stock prices were 50% lower, even if they were going down, I said, hey, I want to buy. I'm not suggesting I'm going to. I'm just saying if I did, I could say, well, my downside becomes more limited and my upside has a lot more potential. So right now, I look at the gold market and I say, there's more downside risk than upside. But when I get down here where all the support is at, it tells me there is more upside potential than downside risk. So let's look at the gold miners. They bounced up today. A lot of bullish sentiment going on here in the gold miners, but they too will roll over and fall down. Quick look at the silver miners. They broke through. This is a support or a resistance zone, and they closed below their resistance zone today. Wouldn't surprise me if tomorrow they make a run back up at it. Failure here says they're coming back down to this $23 to $24 price level. If it holds here again, it's telling us who these people really are. They are the real buyers. They just didn't get all the shares they wanted, and based on this move here, it tells us there's not a lot of shares left they want. So this rally here didn't get it kicked off enough because this is everyone else, retail investors, institutional, hedge funds, computer programs. This is everybody else. So if this move here was enough to get the big players to come back in and short this down so they could buy it up, it tells you we are pretty close to this whole long trending pattern. Let's go to look at the gold miner. We can go back. This whole long trending pattern here is about to resolve itself to the upside, because all these shares have been finally purchased, but they haven't got quite the last of the ones they want. Tells us this comes back down into this range here. They buy the last of them, and then you see this thing going to the upside. And that gets pretty interesting to me. Let's just see what happened in the oil and gas producing world, because we'll get the API report tomorrow from the American Petroleum Institute, rejected at its resistance level right here where I had the bands drawn. It's helpful to kind of know that I actually have them in the right spot, and there's only one way to tell, and that's where people sell. So we see a lot of volume here. There was a lot of buyers trying to push it up, but an equally large amount of sellers. And again, we're still looking at a double bottom or likely something below here before we buy. And so what that tells me is my view that volatility is going to pop. Gold's going to follow volatility up. That narrative looks really good when I look at the gold chart. And then, of course, you have a cheap equity market, which I think is going to be led by oil going out. That's what I think is going to happen. We'll see. I'm Steve Van Metre. We'll see you Wednesday. Bye now.